It's like if we've had an inflection point, and the big question in mind is if this 30-year bull market that we've had in bonds, is it over now or not? That's the big question.
So Gilles, starting off, based on the US Federal Reserve's plan to gradually start raising interest rates, how should this be perceived by bond investors, and is it a good time now to start investing in bonds?
Well, in short, it's not a very favorable environment for bond investors at the moment. I mean, as you say, the Fed is rising interest rates maybe 2 or 3 times this year. But actually what we have observed is that interest rates have started rising already at the end of the summer, not only in the US, but globally. And we understand the reasons. Growth is improving a little bit, inflation is increasing, China stimulus has had an impact as well. So it's like if we've had an inflection point. And the big question in mind is if this 30-year bull market that we've had in bonds, is it over now or not? That's the big question. So the environment is not very favorable for bonds right now, definitely.
And I think the big question is 2017 has seen a lot of market uncertainty, and everyone's wondering if this positivity that we're seeing is going to continue. So how can you deliver a good bond performance in 2017?
Well, I think the first question is to understand why we have bonds in a portfolio, provided we want to have a balanced allocation. And for our balanced investors, maybe one of the reasons to have bonds in a portfolio is to make the portfolio more stable. So we're looking for a kind of defensive bond allocation. What we know for sure is that 2017 will be full of surprises. We know the uncertainties, geopolitics, political, Trump, for example, elections in Europe. So there will be some surprises for sure. So to have like treasury bonds in a portfolio certainly is there is a good point to make because in a risk-off event, we're sure there will be a safe haven and provide some protection in the portfolio. That said, to generate performance in bonds in a rising interest rate environment is quite difficult, honestly. So I would tend to diversify the bond allocation and not take too much credit risk. Credit is a little bit expensive, and interest rate risk could damage the portfolio. So low duration is one thing, and then maybe consider floating rate notes is also an option. Typically loans are attractive, or even cat bonds that provide good diversification in a portfolio.
Great, well thank you so much for coming in today and telling us what to look out for this year.
Thank you.
Well, that's all from us here in the Geneva studios, but if you did like this interview, then please do like and comment on dukascopy.tv.